On a revaluation, $2,800, the minimum market price for gold would very quickly, probably maybe not overnight, it would take a few weeks, maybe a month or two, would minimally go to 17,000. Why is that? Well, if we're to take the bear market bottom price of gold from February 2001, which is a low of $256, and that was as gold was still statutorily $42.22. The ratio of 256 to 42, you'd have to multiply 2,800, and you'd get by that ratio about $17,300. Let's just say 17,000 even.
Economic analyst Rafi Farber, known for his expertise in precious metals and monetary policy, has raised important points about gold valuation in today's market. As gold recently surpassed $2,930 per ounce and approached its record high of $2,940, Farber's analysis provides a valuable perspective on what these price movements mean. Farber argues that the proposed revaluation of the dollar to $2,800 per ounce of gold would be inadequate to clear the market. His reasoning centers on supply and demand. If everyone wants gold at that price, there wouldn't be enough gold relative to the dollars in circulation. This suggests that any artificial price ceiling would create immediate market imbalances. Looking back at historical data provides context for Farber's analysis. In 2001, gold averaged $271.42 per ounce with a low of $253.85. Farber specifically references February 2001's low of $256 and compares it to the statutory price of $42.22, suggesting that after revaluation, gold's price could rise dramatically based on this historical ratio. The recent surge above $2,930, marking the second consecutive session of gains, has been primarily driven by uncertainty surrounding U.S. tariff policies. This has increased safe haven demand as investors seek stability amid market volatility. Farber's most significant insight may be his view on purchasing power. He contends that the specific dollar price of gold is ultimately less important than the massive shift in buying power that follows revaluation. As dollars flow into gold, we would witness the dollar market cap's purchasing power transferring to gold. The practical effect would be that goods and services would become much cheaper when priced in gold, while simultaneously, gold's dollar price would increase. This dynamic illustrates the more profound economic principle. During periods of high inflation, when the dollar rapidly loses value, gold's true significance isn't found in its nominal dollar price, but in its relative purchasing power compared to other goods and services. Before we begin, subscribe to our channel and click the bell icon to stay updated with our latest content, market insights, and expert analysis. Stay informed and never miss an update.
Gold being revalued, or really the dollar being revalued to $2,800 an ounce. That is nowhere near enough to clear the market. If everyone wants gold at 2,800, there will not be enough gold relative to the amount of dollars that exists. The price that would be needed to be able to convert just the monetary base are the dollars that are directly in control of the Fed. M2 are the dollars that are based on the monetary base that banks can lend on top of. So deposits in your checking account are mostly M2, and the monetary base is what the M2, your bank deposits, are based on. A gold price to cover the entire monetary base would have to be $21,340. That's the amount of gold in Fort Knox, supposedly. That's the monetary base divided by the amount of gold supposedly in Fort Knox. You get a price of $21,340. If you want to cover the entire M2, that means if there is a situation where on a revaluation, everyone with every dollar in their account in every bank in the United States decides they want to convert all their dollars into gold, gold would need to be $82,706 an ounce in order to cover all of those M2 deposits. And we're just talking about $2,800. So $2,800 would not be a market price. It is not clearable. But what would happen? This, my friends, is what would happen minimally. On a revaluation, $2,800, the minimum market price for gold would very quickly, probably maybe not overnight, it would take a few weeks, maybe a month or two, would minimally go to 17,000. Why is that? Well, if we're to take the bear market bottom price of gold from February 2001, which is a low of $256, and that was as gold was still statutorily $42.22. The ratio of 256 to 42, you'd have to multiply 2,800, and you'd get By that ratio, about $17,300, let's just say 17,000 even. And why is that? Because $2,800, if we'll just statutorily $2,800, nobody knows. The market does not know who owns exactly, how many times over, how many times it's hypothecated and rehypothecated, what is the encumbrance on the gold in Fort Knox, who exactly owns it with how many claims. The market does not know. The market doesn't even know how much gold is there, which is why a gold audit is being discussed, because the market really does not know. So if the Fed or the Treasury or whoever it is saying that gold that you cannot get, that we do not know how much it is encumbered and how many times or how many owners that gold represents, that gold is worth $2,800 an ounce. How much is gold in your hand going to be worth? It's going to be worth much, much more. If we take the bear market bottom price for gold in 2001, February 2001, at $256, or I think it was 252, whatever it was, then you multiply by that factor, 42 to 252, and you get 17,000. And that's assuming maximum faith possible in the current monetary system at a $2,800 statutory gold price. I believe it will go much higher than that. But the most important thing to understand is that the dollar number for the gold price doesn't really matter. Once there is a revaluation, all of the purchasing power that exists in the entire dollar market cap that exists in the world gets transferred into gold at that rate. So whatever the dollar amount will be, it will be a massive shift in purchasing power from dollar holders to gold holders. We'll see the prices of everything fall precipitously in gold terms overnight as the revaluation happens, and they will continue to plummet in the weeks ahead. And we'll see that in a rising gold price in dollar terms, but we'll see that mostly in a plummeting price for everything in gold terms. Whether it happens by statute or it happens by the market, hyperinflation is just a market-based revaluation of the dollar versus gold or any currency.
Rafi Farber draws parallels between past revaluations and today's shifting monetary landscape, emphasizing gold's role during periods of dollar depreciation. He points to the 1933 and 1934 revaluation under President Roosevelt, where the gold price increased from $21 to $35 per ounce. This led to an immediate transfer of purchasing power from dollar holders to gold holders. The principle that gold's purchasing power rises as the dollar depreciates continues to hold relevance in today's global economy, particularly considering the accelerating de-dollarization trend. Major economic powers like China and Russia are strategically reducing their dollar exposure while simultaneously building up their gold reserves. It signals a fundamental reevaluation of the dollar's role in the global financial system. Farber's analysis gains additional weight when considering similar monetary restructurings throughout history. The 1930s saw gold surge 70% in nominal terms during global monetary reorganization, while the 1970s witnessed an even more dramatic 340% increase as the Bretton Woods system collapsed. These historical precedents suggest that the current de-dollarization movement could trigger comparable appreciation in gold's value, particularly if central banks continue their current gold accumulation strategies. Let's get back to the video.
If the dollar is revalued against gold, then a lot of purchasing power that people thought they had on day X minus one evaporates on day X and X plus one on the day after the revaluation. And where does that purchasing power go? It goes into the gold itself. But let's get a little bit more specific by going back in time and looking at these charts. And I'll show you some historical precedent as to what happened with various prices and assets the last time the dollar was revalued against gold, which was in 1933 and 1934. And the last thing we'll go into is where gold would go now, minimally, on a revaluation overnight to $2,800, which is around the market price, and why it will go there. Dollar revaluation, I'll call it gold revaluation because that's how people refer to it. Gold revaluation is not a new thing. It's been happening throughout history. It happens again and again. It's a way to erase the inflation. And by erasing the inflation, you erase the purchasing power of dollars that go with it. This is what happened to consumer prices the last time gold was revalued from $21 to $35 from 1933 to 1934. So this is the Great Depression. Consumer prices were falling month after month after month. They were going down 9% year over year, around even as high as 10 or 11, 12% year over year. And here is the gold revaluation in April 1933. Prices were still going down around 9, 10% a year. And from there, consumer prices started to rise, and they rose and rose and rose until we get to 1934. This was the final revaluation in somewhere in early 1934. I forgot the month exactly, but we hit, it looks to be around a 5-6% a year in the CPI. So we had massive consumer price inflation as gold was revalued. So we can expect consumer prices in dollar terms to go much, much, much higher. Obviously, in gold terms, they will go down because gold was revalued 66% higher, excuse me, from 21 to 35, and this revaluation will be much more extreme. If we're talking anywhere near 2,800, it's several orders of magnitude more extreme than that. So 42 to 2,800, I don't know, it's a big number. So what happens to gold equities? Miners, streamers, all those stocks that have been dead for so long. Well, here we have a chart from Gold Charts R Us, and we can see here relative to the Dow, gold is this line over here, and it goes up in the revaluation in April 1933, and finally up to $35 in the middle of 1934. I think it was June 1934. What was happening here? Well, the Dow, we saw that we hit bottom in 1932. We hit another close to a bottom here in 1933, and the gold revaluation, rumors of gold revaluation started over here. The Dow started higher, and on the gold revaluation, we were already, it was like a sell the news, buy the rumor, sell the fact kind of thing. And then stocks, at least the Dow Jones, meandered around this level until 1935, and it didn't start climbing until the revaluation was complete. But relative to that, we have Homestake Mining here in the blue, which is the main gold miner back then. And this stock really went insane once the gold revaluation started in 1933, and that's when it really took off.
As history has shown, gold remains a resilient store of value, especially during economic uncertainty and monetary shifts. When the dollar depreciates or undergoes revaluation, gold consistently proves its strength by preserving and enhancing purchasing power. As central banks continue to accumulate gold and countries reduce their reliance on the dollar, gold's role as a stabilizing asset becomes even more critical. How do you think future shifts in the global economy will impact gold's value? Let us know in the comments. If you find this video helpful, like, subscribe, and hit the bell icon so you don't miss any future updates. Thank you for watching.